The slowdown is very important for the Australian economy. China takes around about a third of our goods exports, mainly commodities, iron ore and the like. So what is happening in the Chinese economy is really important to our export sector, which feeds back into our corporate sector, and then national income and tax revenue for the government and the like. So the fact that the Chinese economy is slowing down, that it's got concerns about the growth outlook, that price pressures are hinting at deflation is a real problem, not just for the Chinese economy, but the spin-off back to here in Australia is an important negative for us.
And so in what ways will we begin to witness here the ongoing slowdown, and when?
We're already starting to see it a little. The price of iron ore, for example, has gone from $140 a tonne to around about $90 a tonne. So that fall in the price of iron ore is one way that we're seeing that. And that's fed into our international trade surplus, which was running at about $15 billion per month. It's now about $5 billion a month. So that's $10 billion per month we've lost from our export receipts. And it's also impacting on export volumes, the volume of goods that we're exporting to China, that's starting to ease as well. So that's taking a little bit of a clip off bottom line economic growth for Australia when the domestic economy is already weak. So that slowdown in China is happening at a time, an inconvenient time, if you like, for Australia, when we're already slowing down.
Many economists question why China's government hasn't provided more stimulus to support its 5% growth target. What is your view on China's current economic strategy?
While the Chinese authorities have a great way of stimulating their economic activity, they've been trimming interest rates, they can use budget policy, fiscal policy to really kickstart their domestic economy, there still comes a point where that is only partially successful, that the economy is under such downward momentum from what was really a decade or more of overinvestment in the property market in particular. And so those things don't turn around quickly. So to the extent that they have been easing policy already, that's a good thing for the Chinese economy and hopefully for Australia down the track. But for the here and now, it's not the sort of economy that turns around very, very quickly.
And so how much more insight into China's economy is Jim Chalmers realistically likely to leave Beijing with?
Oh, look, I'm hoping that the Treasurer does unearth a bit more about the true momentum of the Chinese economy. Sometimes it's very hard to get a read on GDP growth and retail sales, industrial production. These sorts of numbers are not particularly transparent in the Chinese statistical base. So if he can get from the Chinese finance minister and other people that he's meeting, the central bank there, that he can sort of get a feel for just the momentum in the economy, it'll feed into his deliberations as he's preparing the mid-year budget update, which is due in only a couple of months' time.
Could further stimulus be dependent upon the outcome of November's US elections?
The US election is a real potential thorn for the Chinese economy, and it's almost regardless of who wins that I think what we're seeing already, but will probably intensify, possibly if Donald Trump were to win, is a trade war, and that is increasing tariffs on Chinese goods being imported into the US. That has a negative effect clearly on the Chinese economy and has a problem for global trade. And for Australia, we're caught in the backwash of that while it might not directly impact our exports and imports from China or the US for that matter, the fact that these two superpowers, these two economic powerhouses of the global economy are having a fight, having a trade war, does have negative implications for us in Australia.